So first of all, taking a look at the last year, we have almost matched the record volumes that we saw in 2007. You see 13 billion on the left-hand side of that chart. In 2017, our provisional figures are just suggesting 12.9 billion. It might get revised up, but we're there, particularly strong in the fourth quarter. So CEE investment volumes are indicating that this cycle is very strong. And as said, we're overtaking that probably overtaking that 2007 boom year in 2018. That is our view. I'll show you the breakdown of the countries of that 12.9 billion. Just briefly there, Hungary on the left-hand side, 1.8 billion worth of volume, which is around 15% up. Czech volume steady, Polish volumes a little bit up. The real performer in country terms was Bulgaria. We had three large shopping mall transactions in Bulgaria with South African buyers, which pushed the Bulgarian volumes up substantially from last year's 261 million. Romanian volumes broadly flat, Slovak volumes actually down. So really, Hungary and Bulgaria were the stars on the country front. In terms of sector, it's retail and hotels that have grown the most. So the retail sector, as mentioned in Bulgaria and in other countries, we've seen South African purchases and purchases by other players in that sector. In industrial, we had the one key transaction with Logical transaction with CIC buying the assets, Chinese CIC. But it's also then the hotel sector where we've seen volumes double to 988 million, that bright blue bar on that right-hand side pie, 988 million, that's doubled. Hotel sector does tend to indicate a strong economic cycle. People tend to come to buy hotels and to transact in hotels towards the top of the economic cycle. That tends to be the case. So that's an interesting indicator in itself. But that sector is booming. Moving on, now, can we keep going? This is the bearish picture. This is the picture which suggests we might not. EMEA investment volumes, the light blue line on this chart, have fallen for the last 2 years. Now, some of that's due to Brexit, but it's not entirely due to Brexit. It's due to some weakness in the Eurozone. Given the latter, it may be that blue line kind of steadies, the light blue line steadies in 2018. That appears to be most likely. But can the dark blue line, which you can see there is kind of tracking the light blue line, but with a lag in time, can we continue to defy EMEA, that EMEA downturn? In 2017, we did, as I showed you on the previous two slides. Can we continue that in 2018? This chart suggests we can. This is a chart that I created last year and put in our outlook last year, and I've just updated it for this year's 2018 outlook, which we're publishing today. The consumer sentiment indicator, if you blend this for the CEE 6 countries, so this is the Visegrad 4 countries, but Romania, Bulgaria, blend that together. This is a sentiment indicator that's released monthly. That light blue line, I've pushed it ahead in time 18 months. You can see some match there with the investment volumes. Now here I've split them 6 monthly because I've got that 18-month lead. But you can see there a broad relationship between these two things. It's suggesting that jagged blue line, dark blue line, will continue to rise slightly. So that's the increased volumes, probably, that we expect in 2018 and possibly into 2019. Obviously, I'm following this consumer sentiment indicator all the time. If that suddenly turns down, I'll let you know. What's really driving that? GDP growth. We're seeing the consumption side. We're seeing strong wage growth in the economies, much higher than inflation, meaning that people have wealth, are acquiring some wealth relative to the past. We're seeing investment from within the region, from the EU itself, and we're seeing external demand. So the Eurozone actually grew at 2.5% last year. This was announced 2 days ago by the European Commission. That's the highest rate of growth since the 2008 financial crisis. So Europe's in a pretty good state, and the European locomotive pulls the Central and Eastern European train. So the exports to Europe is driving this economic growth. Now you can see there, Romania stands out, third quarter 2017, growth of 8.8%, and that's really an example of an economy that's now possibly overheating. It's growing too fast. And what happens then is that inflation comes because the economy is growing too fast, there's too much demand, there's too much consumption, and then you get interest rates starting to rise in reaction. The central banks have to act. In Central and Eastern Europe, the Czech Republic has raised rates twice already and may do so again today. They're meeting today. And the National Bank of Romania, in reaction to that strong growth, is raised rates in January as well. So this cycle is starting to turn, and us in the real estate sector have to acknowledge it. We have to realize that this may impact funding rates going forward. So the cycle in real estate in the region is probably starting to mature. But in the meantime, we see strong rent growth. So I've got here an example of the Budapest office rent situation. This is the absolute level of rents in Budapest is this dark blue line. Now I've lagged this 30 months. I've pushed it back. So the point at which the dotted arrows is actually the present level of prime rents in Budapest. And I've matched that to the GDP growth picture, and that's the actual historic GDP growth in the light blue. See some kind of relationship there. Obviously that dark blue line's not moving around very much, but in some other countries it moves around a lot more, and the match is just as strong. So we've got a 30-month lag there. GDP growth does relate to rent growth in the office sector across the region, and suggests at this point that we're likely to see reasonably good support for rents, prime rents in Budapest over the next few quarters. So that's good. But will the supply side react to this? Looking at the remaining fundamentals, I wanted to show you from the economic side. I mentioned strong wage growth driving economic growth. You've got it here on this slide. The dark blue bars on this chart are the CPI inflation rates. So we take Hungary right now, 2.1% CPI inflation. The Hungarian average wage growth that we expect in 2018 is 10%, the light blue bar on that chart. Last year it's 13%, as you well know, I estimated up to for the full year. The last figure that we had was actually for November. The gap between those two is wealth generated. It is money in people's pockets. They are receiving 10% more wages. They are paying, in terms of prices in the shops, 2.1% more. So this is real wealth generation for Hungarians. And you can see this is across the region. And it looks like this continues into 2018. These are our predictions for the wage growth. Obviously, the CPI, what happens is those dark blue bars rise because more and more consumption happens, the economies grow faster. And I'm actually, for my 2018 outlook, calculated that back over time, if you look back over time to the year 2000 in Central and Eastern Europe, when we've seen periods of very strong nominal wage growth like this, there is a positive GDP growth effect 3 or 4 years afterwards. So there's a correlation between these things, and that indeed, as we all know in this room, is also what drives the real estate sector. Because people, if they are wealthier, gradually getting wealthier, they participate in going to shopping malls, they participate in the economy by working in a new office, they participate in the economy maybe by buying a house. So these things are driving the development of the real estate sector within the overall service sector. So what does all this mean for yields across the region? What we've seen is some compression compared with the end of 2016. Annotated there, Bucharest industrial down 50 basis points. Here, in Hungary, we've seen reduction in yields across the board. In Budapest, 50 basis points in each of office and industrial, 25 in retail. We expect further compression in office and industrial yields in 2018 on the back of strengthening rent growth. We see rent growth across all three sectors, all three of the major sectors, office, industrial, retail, traditional shopping centres. We expect rent growth in all three of those, and that's actually the only country of the 6 where we expect that. So actually, Hungary is the most bullish picture of all on rental growth. The others, some sectors are growing, particularly office rent growth in several of the countries. Elsewhere, Bratislava, we've actually seen an uptick in retail. It's the only uptick that we've seen. There's a lot of supply of new retail coming in Bratislava, and the shopping centre space per capita is extremely high. So a bit of a backing up there, interesting. And then really Sofia in Bulgaria, seeing big moves down. Now, Bulgaria is the least liquid of these 6 markets by a long way. And those South African purchases I mentioned, particularly in retail, have driven yields down there to 7.25% in terms of the latest transactions. So Bulgaria's seen the yields come in the most, but it's the most illiquid market. And there's a political risk premium there. I was in Bulgaria speaking at a seminar for Colliers on Monday, and I can confirm that that's the knowledge and the sentiment, and people know that's why the yields are at those levels. And interesting, there were regional investors attending that seminar, so people are looking at Bulgaria at this point. Now, turning to the risks, if we have higher inflation, that's, again, these dark blue bars, and I've thrown in Germany and the USA on the right for some comparison. This is the CPI inflation rates. Now, rationally, in economic theory, what you should have is higher bond yields than inflation rates to try and control inflation. It's called real interest rates. So, for example, in the USA at the moment, you've got a bond yield, 10-year sovereign bond yield of 2.66% there on the right-hand side versus inflation of 2.1. That makes sense. What doesn't really make sense is what the situation is in Germany. Now, there you've got inflation of 1.7%, and you've got a 10-year bond yield, the Bund, 10-year Bund, at 0.63%. Now, everyone knows why. The ECB has been suppressing interest rates to try and bond yields to try and stimulate the Eurozone economy. So everyone knows why it's in this situation, but you can see several of the other countries are in that situation, including, for example, the Czech Republic there, with lower bond yields than inflation. So, in our opinion, this must change. And indeed, over the last 12 months, the direction of movement in Germany and the USA has both been up in terms of these bond yields. In Czech, it's gone up. In Romania, it's gone up as the interest rates have started to rise in these countries. But here, it's gone down. In the face of it, CPI starting to accelerate in Hungary, the bond yield has gone down. So the result in Hungary is that they're almost equal. So that's, for me, as someone who follows economics, that's not sustainable. Slovakia is the same. Bulgaria is the same. So in some countries, we will see a backing up of bond yields. Now, what does that mean? If we compare the real estate yield, so those yields that I was showing you on the previous slide, so I take the blend, just a simple blended average of the prime real estate yield in the capital city. So that's what these lines are, and minus those sovereign bond yields over time, you get some kind of idea of what I call the funding cushion. How much room have we got between the yield that you're receiving, in theory, and the yield that you're paying in local currency terms? Now, obviously, most transactions are funded in euros, so there is a euro funding rate, but that is not very transparent. So I've taken here the sovereign bond yield as a proxy. It's just giving us an idea of where we are relative to the past. In Czech and in Prague and Bucharest, the grey and the blue lines on that chart, they're falling. They're falling. They're falling back towards, and they are at their historic long-run averages. Now, if the real estate yield stays flat, or even if it compresses, then and the funding rates go up, as I've mentioned, interest rates are going up in these countries, then that will fall further. And this is kind of, as I've written at the bottom, it's effectively the IRR potential. The bigger the gap, the bigger the amount of profit that can be made on an IRR basis. On the right-hand side here, we've got Budapest in dark blue. So there, versus history, it's not looking too bad in terms of there is a cushion. But over time, if the funding rate, if the central bank finally actually has to start raising interest rates, that will start to turn down as well. But there's no sign of that at the moment. So no imminent threat here, I would say. But certainly, if you're looking at Czech and Romania, this is much more of an issue right now in the cycle. Now, moving on to another major theme that we've featuring in our outlook that we're just publishing, development boom. The light blue line is an economic or real estate cycle. Sine curve cycle, that's how it works. What happens in the real estate cycle is that as we get more exuberant, as the cycle progresses, the developers get more and more excited. And the developers develop more, and they develop faster. And then they overdevelop, because demand eventually turns down because interest rates rise, the economies slow down, and then there's too much supply. So at the top of the market, we've had too much developed, and then suddenly it plunges. And so that dark blue line is more volatile, it's got a bigger amplitude. But it plunges fast. So once we get down to the bottom of the cycle, say 2008, 2009, 2010, the developers get very depressed, the world's ending, and everything plunges. And then it turns. And this is how economic cycles work. So this is the theory. Here's the practice in Hungary. Construction sentiment, as measured by Eurostat, every month is in the dark blue. The light blue is the overall economic sentiment in Hungary. You can see the same sort of pattern going on in Hungary, as I showed you in that theoretical chart. Particularly, you'll see this huge change in construction sentiment in Hungary from the pit of the global economic crisis to now rampant. Obviously, you can ask our panelists about this. Now, construction costs are rising very fast in this market. There's labour shortages, a lot of issues connected with that at this point, but that is what's happening in terms of a boom. So there is a boom happening. I've drawn this chart for all 6 countries. It looks something like this for all 6 countries. That same historic pattern and optimism now. Now, just to finish up, just briefly on the residential market, and it's not something that everyone follows, but it's very interesting as a barometer of the strength of these economies. Got the house price growth in the EU, in the selected EU countries, including all of CE6 in the dark blue line, dark blue bars there. Hungary, 10.2% growth up to the end of the 3rd quarter last year. So the residential real estate market in these countries, check their 12.3% growth, the fastest in the EU. I live in Czech Republic, I can vouch for that. Growing extremely fast. Now, this is, as I said, an anecdotal piece of evidence that we've got a strong cycle on our hands at the moment, and central banks are probably going to have to, as I've been mentioning, react to this. Now, how long does it take? We're not worried too much about 2018. The title of my outlook is actually The Ascent to the Peak. So we are on the mountain, we're climbing the mountain, but we haven't reached the top. We probably won't reach the top in 2018 unless the development boom suddenly takes off and we actually hit the peak this year. But we've got continued momentum in consumption-led GDP growth happening. We've got strong rents story in retail and now increasingly in office. We've got wage growth that feeds into the retail sector in terms of the revenues that tenants receive. We've probably got a development boom coming, or perhaps here already, certainly here in Hungary. We've got a technical spike probably in inflation. The Eurozone CPI is now at about 1.5%, 1.5%. That could, given the movement of oil prices and other factors, could be higher towards 2% in 2018, might result in the ECB finally changing its quantitative easing policy. And those rate rises I've mentioned are not immediate. We've got these big funding cushions, as I tried to describe, the space for in terms of protection of real estate commercial yields at present levels, or even compression, as we've been thinking in Hungary, that those cushions are wide. So we're not going to see an upward correction in yields as a result of what I've described. But the risk is rates rising, inflation spike. And then some specific risks, e-commerce, big risk for retail. One statistic I've looked at from a provider in Czech Republic, APEC, suggests that 1 in 10 transactions in the Czech Republic are now online. And we don't even have Amazon there yet, locally. I mean, personally, I have Amazon deliveries from Germany delivered to me in Prague. So it's there. E-commerce is happening in retail across the region. And for somewhere, even like Bulgaria, where there's something like 1.3% of transactions in Bulgaria are online, that sort of thing can double very quickly and double again, as we've seen in other countries. So it's a threat. It's a threat, and it's a constant threat, and we must take it into account. In terms of the wage growth issue, it's more negative for BPO SSC, so within the office sector. So here, and then particularly if you look Southeast Europe, big component, also in Polish regional cities, big component of the office market is BPO SSC. And if we see wage growth, this starts to bring their competitiveness into question on a global basis. Industrial suffers from this. And there's the anecdote that I picked up yesterday from my colleagues at Colliers in Miskolc, Bosch. There's a strike going on at the Bosch factory. The workforce last week rejected a 10% pay rise. They want more. So this is exactly an anecdotal piece of evidence of this happening right now. Could a development boom force up office vacancy rates? Will we get overbuilt? Possibly. Probably not in 2018 unless something crazy happens. But it's something certainly I would think about for 2019. And then at the bottom, just some macro risks. I mean, in Eastern Europe, we've got a collection of governments at the moment, or not a collection of governments, in fact. We have no government in the Czech Republic. We have 4 Romanian prime ministers now in 18 months. We've got elections here in April in Hungary. And I've just been to Bulgaria. The Bulgarian government is it's polarizing the population a little bit, pro-EU, anti-EU. And Poland's situation is well documented. We've had some taxation risk actually in Poland, and also some worrying developments there for the real estate sector. So a little bit of an issue on the political side, but obviously the EU might intervene. They're not liking what Poland's doing to its constitution. They might punish Poland, might reduce funding in terms of regional fund flows. So that's a risk. And then global risk, taxation, generally, the possible taxation of assets, taxation of capital rather than taxation of labour. So this is the concept, I believe, behind Brexit and the election of Mr. Trump. And then a constant risk globally is debt instability from China, which China is now a very large foreign direct investor in southern and southeast Europe, and even here increasingly. And then if Mr. Trump does something on the trade front, that might disturb asset markets. Asset markets are very rich at this point. Equity markets are at all-time highs. So anything that comes along could actually see valuations go down very quickly in equity markets, and that might spill over into real estate. So that's what I wanted to say. Thank you very much, and I'll pass you over to the real experts. Thank you.